For existential survival of our country reasons, we need to take interest rates down to make our interest burden lower, period, full stop. Look, we're in World War III. We've got to have the money. This is existential. It's a matter of national security. We have to rebuild. We have to retool. Ignore the man behind the curtain with the inflation issue. I think they can and will say that. That's my gut as to where they go. I think it probably happens this year, primarily because it feels like we're coming to a head on this war and on the monetary situation. There's a whole part of me that actually kind of thinks all of this is planned. And certainly I look at the Iran war and I say to myself, this just does not make any sense unless you really want to, debase the dollar and get the U.S. out of the Middle East. What you can see is when the money, the bank money in the system, the black line, falls below the growth of the debt, the underlying compounding growth of the debt, boom, something breaks and they have to print. They'll create some new program and it will be money printing, but they will say it's not money printing. And, maybe they'll have a special purpose vehicle. Maybe it'll end up on the Fed balance sheet. One thing that you can do is they go all the banks and they can, change all their supplementary reserve requirements and say, look, you can buy as many treasuries as you want. Maybe they'll incentivize them to buy treasuries. To those who say, there's no such thing as paper Bitcoin and Bitcoin can't be manipulated, I say bullshit. I can say, hey Joe, I'm going to sell you a Bitcoin for $75,000, and I'm, and you can say, fine, I'll send you $75,000, and now Larry owes Joe one Bitcoin, and so your demand for Bitcoin, your $75,000 that you wanted to spend to buy a Bitcoin, rather than going into the market with a broker and buying the actual Bitcoin, you bought a Bitcoin derivative from me, and now I owe you one Bitcoin, but let's say I don't have that Bitcoin. So effectively, your demand did not reflect in the price in the marketplace. It just reflected in Joe and Larry trade. All of that suppressed demand, all that suppressed paper demand is going to come into the market at one time. And that's why, it's my belief that when this thing really does move, we're not going to 126. We're going to 200 or 400 or some bigger number, but it's going to blow through that by a significant amount because people are going to, the shorts are going to be trapped.
Welcome back to Over the Horizon of Bitcoin podcast. Today, I'm once again joined by Lawrence Lepard, Bitcoin extraordinaire, author of The Big Print. Lawrence, how's it going?
It's great, Joe. Really nice to see you again. I'm happy to catch up.
Absolutely. Always great to chat with you and catch up. I want to jump directly into one of the pieces of news that I think gets you really fired up, gets me really fired up too. And that's the fact that the S&P 500 is up like 13 or 14% in the last week. Yet we have consumer sentiment near a 50-year low. And the share of consumers who are worse off than they were a year ago, which is a sentiment survey, is at a record high.
Right.
So what's your take on this? What's causing this? In my view, it sort of it epitomizes the fact that the money is more broken than ever. But how do you parse this out?
Yeah, I think that's exactly right. You nailed it. The money is broken, and I tweeted about this. If anyone wants to go take a look at my stream, it shows the charts on those particular issues. And yeah, it's somebody actually. One of the replies to my tweet was very intelligent. He just basically said, "Yes, that's because the S&P 500 is measured in dollars, and the sentiment is based on buying stuff in dollars. And so what I think is really going on here is the dollar is just losing value so quickly now that, this is the share of people who think that they're worse off. I mean, look at this. Isn't it amazing that more people think this is, the chart is consumers saying their financial situation is worse compared to a year ago. Mm-hmm. And as you can see, it's the highest ever during that data set from the late 70s. So this is, people feel worse today than they did in 2008, which was pretty tough.
And worse than the 20% inflation in the 1970s.
Yeah, and worse than the 20% inflation in the 70s, and worse than they did, after the dot-com bubble burst in 2000. So things are quite bad. And I think the reason for that is that everybody knows they're just losing purchasing power. And yes, the stock market's going up. I mean, that's really kind of a mini crack-up boom, I think is what's taking place. And by crack-up boom, I mean that just so much money is in the system and it flows to things that can't be printed, and you can't easily print stocks. You can print stocks, but not as easily as they print money. And so, people are just getting roasted by inflation everywhere, and they really feel it. The other chart is consumer sentiment, same story. Consumer sentiment today is worse than it was in 08, 09, 2000, and even back, in the 80s, in 1980s. So the reason is, it's just the inflation. Everything is going up and becoming more and more expensive. And yes, if you're in the stock market, there we go. This is the consumer sentiment, Michigan consumer sentiment chart. I mean, look, in May of 1980, inflation was 14%, unemployment was 7.5%, and we're below that level of sentiment today with inflation theoretically at 3.3, although we know they're lying, and unemployment at 4. And again, it's just the fact, Joe, that that inflation is hurting people so badly, and and the money is so broken, and that's why it's hurting people. And yet the stock market just keeps marching higher, and so those people who are in the stock market are benefiting from that, but they also have to go to the grocery store and buy groceries. So it's what happens as money breaks and currencies fail, and I think we're well into that process of currency failure. Um, it's getting serious now because we can see what happened to the price of gold, and it hasn't been reflected fully in Bitcoin yet, but it will be soon, in my opinion.
Yeah, certainly. It certainly seems like that. Speaking of which, pivoting into sort of Bitcoin's performance over the last month, it's held up quite well. And until
Yes.
recently, until very early this month, actually about 10 days ago, it seems to have been the best performing asset in the major macro asset complex, better than the S&P, better than the NASDAQ. What do you think that was attributed to? I spoke to James Lavish on last week's show, and he said he largely thinks that it's primarily the fact that Bitcoin did so poorly last year that a lot of the bad performance was already front loaded. And so that's why it was pretty resilient, whereas the S&P 500 hadn't necessarily rolled over as much. Is that what you attribute it to as well, or is there something
I
different
agree.
going
I
on?
think I think a lot of it is the fact that all the juice had been squeezed out of Bitcoin, and the sentiment was absolutely dreadful. And as we all know, there was that one spike down to 60K, and of course everyone thought it was going to go to 50 or 40. It didn't. Yeah, I think that's most of it. I mean, since the war started, it's interesting. Bitcoin has performed better than gold. But I think again that's because gold moved so far last year. I mean, gold was up 65% plus last year. So Bitcoin is in my view long overdue for doing that big catch up compared to gold. And you and I have done this before. We've looked at the chart that compares the two, and on the Bitcoin gold ratio right now, Bitcoin is incredibly cheap compared to gold. But I think nominally, because the money is in the process of failing, nominally they're both going to go higher. I mean, I expect this year to see gold go to 6,000, maybe seven, but I expect Bitcoin to double or more, sometime in the next 12 months, maybe even higher. I mean, it's really been suppressed, and as we all know about the most recent strategy news and how much the STRC, the stretch they're selling, they're buying multiples of the existing mine supply, and there's a point in time at which there just won't be enough to satisfy them at this level, and it'll have to start going significantly higher.
Absolutely. It certainly seems that way. Yeah. Gold right now is at 4,800. That's a bold call, $6,000 gold before the end of the year. What makes you consider that?
I just it's still the go-to first choice of governments and a lot of large institutional investors. I mean, Bitcoin I think is going to go further, faster. Be a better performer. But you've got to remember, I mean, it's funny. I mean, we're early in the gold world. We're super early in the Bitcoin world. I mean, remember that still, the portfolio allocations to gold, across the spectrum, and this will be in my quarterly report, which should be out tomorrow, Friday. It's still like under 4%. I mean, nobody really owns gold. Everyone thinks, oh, gold went up a lot. It's a bubble. It's a time to sell gold. I mean, no, gold has been so suppressed for 20 plus years that even after it goes up a lot, it's still cheap. And if gold is cheap, Bitcoin is even cheaper. But the reason gold has outperformed Bitcoin in the last year or two, last year and a half, I would say, is because at the sovereign level, there are very few sovereigns who really understand Bitcoin. I mean, the UAE does, and I think Russia does. I don't think China fully does, but there aren't sovereign banks and investment, or I mean, investment funds buying Bitcoin. There are a few small ones, but there are no major ones. Whereas there are plenty of sovereigns and central banks that are buying gold, and that continues and persists. So gold is kind of the first choice as the money fails. But once gold has done its thing, Bitcoin's going to come racing by because everyone's going to kind of come to the conclusion that Bitcoin is a digital form of gold, which it is. And there are all kinds of great use cases. I mean, like one of the really interesting ones, I'm sure you saw it, and I noticed it as well, was if Iran is going to start charging a toll for oil to go through the Strait of Hormuz, And they said, hey, we're going to do that. And by the way, the payment's going to be required in Bitcoin. And, I thought, well, that's interesting. Obviously they can't collect gold. What are you going to do? Run a bunch of coins or a bar of gold out for every ship you send through? But in the past, I would have thought, well, they'll use stable coins. But then I did some digging and some research, and I discovered, you know what? The U.S. is really, they've got their arms around Tether and Circle, and they've now been able to sanction stable coins. And, the stablecoin market grew and came into existence primarily because we threw these countries like Russia and Iran off the SWIFT network, so they couldn't move money easily. We weaponized the dollar. Well, okay, that was what led to stablecoins. Well, as it turns out, in my research, I discovered that about $4 billion of stablecoins have been seized. So, the Iranians aren't stupid, and if they want to get paid, they're going to get paid in something that the Western financial system can't grab. And the only two things that fit that model, is sovereign money that's independent from the system are gold and Bitcoin. And obviously, gold's clunky. Bitcoin's as easy as a 10-minute transaction. So I thought that was a very interesting development.
Certainly, it definitely seems that way. And James also on last week's show mentioned that one of the greatest geopolitical blunders the United States ever made was seizing Russia's U.S. treasuries, because that showed every nation that could potentially get into conflict with the United States that U.S. treasuries are not a safe thing to hold. So all of a sudden, you're driving incredible demand for gold, but with a nation like Iran and with like this really high frequency, high volume transactions that need to get done. Hard money is great. It's a great thing to store your money in, but gold isn't necessarily cut out for what needs to happen with the Strait of Hormuz if they're trying to charge this toll. And so Bitcoin sort of fits the bill extremely well. And it made a lot of sense why they chose that over stablecoins, because they cannot be seized. The math is actually quite staggering on this.
Yeah.
If this does wind up happening, prior to the war starting, about 20 million barrels of oil used to cross the Strait of Hormuz daily. Iran wants to charge a $1 toll on every single barrel, so $20 million. That's about 280 Bitcoin worth of incremental demand every day, which is more than half of the new mining supply. It gets quite staggering.
It really does. Yeah. Look, I mean, more and more people slowly but surely are coming to understand what Bitcoin represents. And I think this next bull run is going to be, it's going to shock some people. I mean, I think, I know people, there are people who are calling for 50,000, 40,000. One idiot was even calling for 10,000. That's just not going to happen. I mean, I have friends who say, well, I'll wait till it goes to 50,000, I'll buy it. I say, no, you won't. One, because it's not going to 50,000. Two, because I know that if it goes there, you'll be chicken. You'll say you want 40. And so, my view is this next run is going to take us easily over 200, maybe 300 or 400 on a spike. Who knows? But there's been a lot of paper Bitcoin created, in my opinion. I mean, if you look at the statistics on, perpetual futures and stuff, and I think that's really kind of held it back. But all that paper has to be covered, and it's all algorithmically driven. And when we break through certain levels, you're going to see people who are short it realize that they're facing an existential threat, and then of course they're going to have to come in and buy to cover those shorts, and that's what's going to take us up to prices that are going to be pretty impressive. So. That's all to come in the future. And I think it probably happens this year, primarily because it feels like we're coming to a head on this war and on the monetary situation. I mean, it's, I don't think, I mean, it's almost, and there's a whole part of me that actually kind of thinks all of this is planned. And I've gotten to be more friendly with and more facile with the thesis of Simon Dixon, who kind of believes that there are guys behind the scenes pulling the strings, and that they actually are intentionally trying to croak the dollar as the world's reserve currency to go to a multipolar system, because as a practical matter, we kind of have to. I mean, we've hit the end of the debt road. We can't kick the can any further. It's time for a monetary reset. His thesis is actually that that what we're doing here is intentional. I don't know if that's true or not, but it's certainly, I look at the Iran war and I say to myself, this just does not make any sense unless you really want to, debase the dollar and get the U.S. out of the Middle East, because we're not doing particularly well.
Right. Yeah, I mean, any way you slice it, intentional or not, the end result is the same, which is that the money has to be debased.
Well, that's right.
And I think,
we don't know who's pulling the strings, but we can see what's going on, and it is not bullish for the dollar.
Yeah. Speaking specifically about the paper Bitcoin complex here, this is something that divides the Bitcoin community quite a bit. A lot of folks say that this is a total non-issue. A lot of people who've been around for quite some time, like yourself, who saw a very similar problem with gold being suppressed, are citing this as one of the reasons Bitcoin is not much higher now. Can you sort of explain, in your experience, having seen this with gold over many decades, what might be going on with Bitcoin right now and what you mean by paper Bitcoin?
Sure. I mean, I think that just what happens in any given market, there's actually the physical. Well, and Bitcoin's not physical, but there's effectively the physical. I mean, they're the keys and the coins, and that means you own title to those coins. And then on top of that, people can create a derivative, which is to say, I can say, hey, Joe, I'm going to sell you a Bitcoin for $75,000. And you can say, fine, I'll send you $75,000. And now Larry owes Joe one Bitcoin. And so your demand for Bitcoin, your $75,000 that you wanted to spend to buy a Bitcoin, rather than going into the market with a broker and buying the actual Bitcoin, you bought a Bitcoin derivative from me. And now I owe you one Bitcoin. But let's say I don't have that Bitcoin. So effectively, your demand did not reflect in the price in the marketplace. It just reflected in Joe and Larry trade. And so that's a paper transaction without the underlying physical backing it. So in effect, it's kind of a short, because at some point in time, I've got to go buy that Bitcoin and deliver it to you, but I don't have it today. And we saw, like when Sam Bankman-Fried failed, we saw on the FTX balance sheet, he claimed he had a lot of, he had sold Bitcoin to his customers, paper Bitcoin. There were people who had FTX accounts who thought they owned Bitcoin, but he didn't have any Bitcoin. So he basically just sold them paper Bitcoin. So that demand for the Bitcoin that they had did not get reflected in the marketplace, because he just created a synthetic paper obligation. So to those who say, there's no such thing as paper Bitcoin and Bitcoin can't be manipulated, I say bullshit. There is definitely paper Bitcoin. However, there's not nearly as much paper Bitcoin as there is paper gold. They've had 50 years to perfect the paper gold market. They've had 15 years to perfect the paper Bitcoin market. And the other thing I would say that's a really important thing to understand is that gold has never gone up 5x in 10 months as Bitcoin did from October of 2020 to, the following May or June. So, actually less than 10 months, like 7 months. So, and that's kind of a rip your face off sort of move if you're short, the paper. A big year for gold is up 20, 30%. There were a couple of years were up 50%. So, and the powers that be at the BIS and the Federal Reserve and, all the central banks, I mean, they have the ability to absorb that kind of loss. They also have a printer to fill in the holes. With respect to the paper Bitcoin, basically, the perpetual futures market, I haven't checked it recently, but it's gotten to be fairly good size, a lot bigger than it was 4 or 5 years ago, but still a fraction of the total outstanding trading on any given day. Not a fraction, but it's not as big as the trading on any given day, and it's not as big as the float that's out there. So it's clearly creating some supply, some artificial supply, but the people who've sold it short, who basically sold a contract to somebody who wanted to buy Bitcoin, they're going to have to cover those shorts at some point. They're going to get their face ripped off if this thing starts moving quickly. And in this instant transaction kind of world, they've got all these kinds of algorithms and other things set up such that once it starts to move and move hard, they're going to come in a big way to unwind those positions. And that's how and why we get these huge amplitude swings. I mean, one of the things, there's some great documentation. If you go back in the 70s when the gold wars were occurring and, the London gold pool was taking place, there were some things written by Kissinger and others who basically said, look, if we make this gold price so volatile, people won't want to buy it because it'd be just too scary to buy it if it has these big ups and big downs. And boy, does that ring true with Bitcoin as well, right? And so, there's an argument that the other side of our trade likes the fact that they can hold it down and then let it rip and then hold it down and let it rip, that the volatility, and that does scare a lot of people away. I think when I try to convince people to buy Bitcoin, probably other than, well, it's crypto and it's FTX, and once you get them through that, then you have to get them through, you do understand this thing could go down 50%. And the average person is loss averse. They're not necessarily profit maximizing. I say, yeah, you're right. It could go down 50%, but it also could go up 4x. And, if you think the balance of the two is maybe a 50% chance of each, 4x up versus 50% down, that's a mean expected value. You should do it. And so the Bitcoin suppression, I think, that occurs through volatility, it's very real. But again, I say that I don't think they'll be able to do it the way they did it with gold because of the existential threat of a 5x move. Because it's so volatile, when it starts to happen, when it really, this is Samson's God candle, when it really starts to move, the people who are on the wrong side of this are going to have to buy or they're going to face an extinction event. So all of that suppressed demand, all that suppressed paper demand is going to come into the market at one time. And that's why, it's my belief that when this thing really does move, we're not going to 126. We're going to 200 or 400 or some bigger number, but it's gonna blow through that, by a significant amount because people are gonna, the shorts are gonna be trapped, and it's possible that there are gonna be some BKs, some bankruptcies on some of these shorts. I mean, the other thing is TradFi, who I know, and I know TradFi players have done this, who, for example, they shorted, and it was a decent trade for a while. They shorted Bitcoin while being long the Mag 7 because they were so heavily correlated and they wanted to be long the Mag 7, but they were concerned about, the risk of the valuations. And so they shorted Bitcoin against it. And to me, that's just an incredibly stupid trade because the Mag 7 is overvalued, Bitcoin is undervalued. But, for a while it worked. But when these trades reverse, they can really reverse with a vengeance. So I'm not long-term concerned that they'll be able to paper over the Bitcoin market. There are other people who take the other side of that, and they have an argument. They could be right, but remember, at the end of the day, it's very easy to verify and demand, proof of coins, and a derivative does not represent a proof of coin, and so, when things start running hard, the people who are short the coins are going to be in a lot of trouble, in my opinion.
Certainly, I'd wager so. Particularly for me, I think that this problem is coming to a head now that the ETFs are rising so rapidly. Morgan Stanley just launched their own. You see Goldman Sachs now in the market, who is launching a premium income ETF that uses IBIT. Chances are that's them dipping their toe in the water to see if it would make sense to launch their own ETF. In my mind, it becomes more difficult for the paper Bitcoin complex to survive when the ETFs are gobbling up so much Bitcoin and the auditing requirements for these ETFs are so stringent. Whereas with gold, it may be more difficult to audit whether or not the gold ETFs actually hold X, Y, or Z amount of what they claim they're holding. With Bitcoin, it's far easier.
I think
And so
that's a
for
good
me,
point. I didn't
yeah,
make that point. I think you're absolutely right. I mean, unless the auditors are lying, they've got to see the proof of those coins and the keys. And I know for a fact that with the GLD ETF, the prospectus said that they were able to buy futures and contracts. And so they were able to buy gold. They thought they bought gold from somebody who thought they sold them gold, but the seller didn't really have the gold to sell. They just sold them a paper contract. And so, yeah, look, derivatives are a dangerous, dangerous thing. I mean, if you think about what derivatives are, they allow people to make bets on, this is what caused the GFC in 2008. They're just side bets on the underlying price, but they can greatly distort the underlying price for a long period of time until somebody says, give me the goddamn coins, give me the goddamn gold, or show me the value in this CDS, as was the case in 2008, and then when they do, it all comes crashing down very quickly. And so, again, I can't predict it. I'm not saying it's going to happen, but it's entirely within the realm of possibility that at some point in time, Bitcoin is going to go up a lot more than anybody ever imagined. So.
yeah, it definitely seems that way. Eventually, we'll get Samson's God candle.
Yeah, right. Yeah.
I want to shift into talking about the war specifically. I found this post that you retweeted from Luke Groman to be particularly interesting. This is a chart of the 10-year U.S. Treasury yield and oil denominated in the Japanese yen and the Chinese yuan. Basically, what he's saying here is that in the same way that this conflict and the oil shortage caused a lot of countries to begin selling off their golds in order to fund that oil deficit. What's happening now, this oil shortage could drive a lot of U.S. oil importing creditors like Japan, China, Korea toward oil deficits where they need to sell treasuries to refinance. So basically what he's saying here is that taking a look at oil priced in the yen and the yuan, that kind of tells us where the 10-year U.S. Treasury yield is going to be. And you could see over the last 2 years, it's been pretty much perfect.
Yeah, there's been a lot of correlation, and then you can see the breakout, right? Because of the the spike in the cost of oil, and probably also weakness in those to some degree in the currencies. Certainly the yen. I
Yeah.
haven't looked at what the yuan has done recently, but yeah, I mean, look, if this correlation exists, the U.S. 10-year is going to have to go one whole lot higher. And there's a lot of debate around this. I mean, if you followed the thread that Luke put this on, he got into it with Tom Luongo and some others who said, no, you're not looking at it correctly. And you may not look, I don't know if he is or not. I think there's merit to his argument. There are other things that these other countries can do. Some of them can sell, if they need dollars to buy oil, they can sell dollar denominated bonds. I mean, there's so many moving macro pieces that we don't really know with any great certainty. And so for Luke to say, oh, this means absolutely certainty the U.S. bond market's going to fall apart, we don't really know that. It could. I think a more interesting one is the one I just tweeted about. Hank Paulson, who was the Treasury Secretary back during the GFC, who went and had to beg Pelosi to get TARP under set up. Basically said, look, the U.S. bond market is at great risk of having a serious event here, which to me, I think he's right. And it's interesting because he knows he's a connected elite. And sometimes when guys like that say things like that, they're trying to signal to market participants and others what's coming. I can't help but think. I mean, if I look at the if I look at the world today as it is, and I look at the war and what it's doing, I look at the disruption that the closure of the Strait of Hormuz, effective closure of the Strait of Hormuz, is creating, I think to myself, my God, this could be a real mess. Now, I'd like to be optimistic and think that we achieve a ceasefire and then a peace agreement. The strait opens and we return, slowly but surely return back to kind of a more normal world. And that's kind of my base case, to be frank. I mean, that's what the stock market is saying and others. But it's not, it's not the only case. The other case is that, things do go wrong and, one side behaves irrationally, whether us or them or both. And, the strait stays closed and, it's starting to have a real impact. I mean, I was reading this morning about how, the European airlines are saying they've kind of got 6 weeks left of fuel and then they're going to have a serious problem. And some of them are already starting to curtail flights, and this is jet fuel. So, the it affects a lot of things. It affects, it affects urea. It affects, sodium phosphate is used for, fertilizer. And urea, and I have charted my quarterly that's just about to come out that shows that fertilizer prices are up 80% since the start of the war. And
yeah, this is a chart of anhydrous ammonia prices.
Yeah, right.
Fertilizer, you could see.
Yeah, so I mean, look, the bottom line is that's used in all agriculture, and so we're going to have more food inflation. I mean, the thing this war is such a mess. And it's coming out in a situation where the Fed really hasn't tamed inflation. I mean, inflation is still running 3%. The target's 2%. I mean, Jerome Powell's got to be saying to himself, I'm the luckiest guy in the world. Because in a month, I'm out of here and it's somebody else's problem, right? And that kind of disappoints me because I was kind of hoping it would blow up on his watch. But anyway, so be it. But my sense is that the fix is in, and Warsh has assured Trump that he's got it under control, and Warsh and Bessent have some things cooked up, and we can talk about that. But to me, I mean, we're walking into a real monetary mess here, and I feel more confident than ever that what I predicted in the book, the title, which is The Big Print, that is coming. I mean, I don't see how mathematically we get away with not having to provide monetary accommodation to keep the system running. Now, the good news is it will keep the system running. The bad news is that inflation is now going to be a serious feature of the world. I mean, it's happening now on 2 levels. It's happening because we're about to have more monetary debasement, and we've already had some. As you know, they pivoted when they went to this reserve management program, started buying $40 billion of bonds, which is not QE, they say.
Yeah, what's $40 billion between friends, Lawrence? You could lend me that.
480 a year. And Lynn's right. It's not a big print. It's a modest print or a gradual print. But if something breaks, we know that their third mandate is to keep the system functioning. So if something breaks, we know with high certainty that they're going to have to come in with a lot more accommodation and printing. And my sense, and I write about this in my quarterly, my sense is that Warsh is already trying to foam the runway on this topic. I mean, again, it's in my quarterly. If you read carefully what he said in his public statements in the last 3 months, he said that the AI productivity improvements provide a real cushion that allows the Federal Reserve to consider having a much lower interest rate. Well, that's interesting. And then, of course, Trump tweeted a few days ago that Warsh is on his way and he's going to bring lower interest rates. And I don't think Warsh got the job without giving Trump some assurances about interest rates. So my sense is, in spite of inflation, which is running pretty high, in spite of the wartime inflation, which is awful, Warsh is going to come in and say, look, all this stuff is temporary. The war is going to get solved. We have to look through it, and AI is providing massive productivity increases, and therefore, rates really need to be significantly lower than they are now. And I'm proposing a 50 or 100 basis point cut right now. And that'll be good for the U.S. interest expense. That'll be good for the monetary system because it will keep things running. That will be bad for consumers because it will lead to additional growth in M2, and that M2 will filter into prices, and that'll be very bad for inflation. And the first wave of inflation from COVID, as you know, took us to 9%. We brought it back down to 3%. And of course, all these numbers are cooked. I'm just talking relative levels. And I think the 3 is going to go to 12 or something higher. I mean, and by the way, once the market wakes up to this, and I think the market's kind of sniffing it out. Gold sniffed it out last year. I think Bitcoin's kind of sniffing it out now. I mean, these things are going to catch an enormous bid. That's how you get to gold 6,000. That's how you get to Bitcoin 200,000. And we're only a month away from Warsh being sworn in or getting the job. Now, there's a lot of talk that he, it'll be delayed because they're going after Powell for lying to Congress about the renovations. And, I think at the end of the day, Besant's going to go to Trump and say, sir, drop that shit because we need to get this guy in here now. So that's my gut. But who knows? I mean, Trump's pretty vindictive, and maybe he'll just want to try and beat that dead horse for a while longer. In which case, what is it, Senator Tillis, whoever the senator is that's holding it up, he'll probably continue to try and hold up Warsh's appointment. So I don't know. We'll have to see. That's like, inside baseball for those guys. I don't know what they're going to do. But the point is that, and again, in my report, and I've talked in prior pods about it, the lines have crossed. I mean, the debt continues to grow, and the money supply has not grown fast enough to support the debt. And there's only one way to solve that, and that's printing. I mean, even 6 months to a year ago, Powell was talking hawkish, and you never would have thought they'd stop QT, go flat, and then start QE. But here we are, and they did. And so remember, they can, remember to watch what they do, not what they say, and then also watch the numbers. And the numbers suggest that they have to print more this year, and they will. So I'm not too worried about it. My fund, for example, was in the first quarter we were down a couple percent because March was a rough month with the war breaking out and everything kind of getting hit. But I'm highly confident that this year will be a very good year for sound money, both Bitcoin and gold.
Yeah, it certainly seems like it. And it honestly, it does provide perfect cover for lowering interest rates because, like the war, in a way, right? For bringing Warsh in. So instead of saying that, oh, Kevin Warsh was a political choice and Trump getting even more heat for that, starting this war just before Kevin Warsh gets nominated, that sort of gives him the cover, if you will, to rapidly lower interest rates because he's going to have a U.S. economy that's floundering.
That's right. And also the cover that, remember he was a hawk. Remember how they sold him as a hawk? Oh yeah, this guy's not a duck. He's a hawkish guy, right? He wrote this editorial in the Wall Street Journal. It's very hawkish. I mean, that's what you want to do. You want everybody to think he's a hawk when, really underneath it all he's a dove. I think he's going to prove to be an enormous dove. And your point is a really good one. And we talked about this before the show off camera. There's no easier way to argue for monetary economy. Just say, look, we're in World War III. We've got to have the money. This is existential. It's a matter of national security. We have to rebuild. We have to retool. Ignore the man behind the curtain with the inflation issue. For existential survival of our country reasons, we need to take interest rates down to make our interest burden lower, period, full stop. I mean, I think they can and will say that. That's my gut as to where they go. I mean, along those lines, another thing we were talking about it's interesting. This morning, I think it was Trump who said it. They came up with there's a tweet where he said something along the lines of, we need to talk to Detroit, and the automakers need to think about how they can contribute to the defense, effort. Well, that to me reminds me very much of World War II, where
Yep.
there were no cars made during 1943 and 44 because all of Detroit was turned into the arsenal of democracy to produce, bombers and tanks. And this is a miniature version of that, but for Trump to say, hey, to me, that's why I don't think this war just goes away. I'd like to think, I really wish it would stop, and I wish we'd get sane, but I don't think it just goes away. I think they actually need it to ramp up because they need it as cover for what they've got to do in the monetary sphere. That's kind of my current thinking on it.
It certainly seems that way. I want to talk about Warsh as he compares to Greenspan,
Yeah.
because just prior to the dot-com bubble, I think 4 or 5 years before it burst, he said something very similar to what Warsh is now saying with AI. He said that the productivity gains as a result of the internet are going to make it so that we can have much easier monetary policy.
Right.
And then we had this massive blow off top in equity indices. So it's really, really eerily similar. Do you think Warsh, that comment in confluence with his other comments, do you think he is most similar to Greenspan, or is there another
I
Fed chair
do.
that
No, I
you?
think he's completely similar to Greenspan. And it's funny. There's even I was using ChatGPT and I found some of his comments. He even referenced that. He's and there are a couple of quotes in the quarterly letter I've just written that talk about how this AI-driven productivity boom would allow lower rates. And he said this is very similar to what Chairman Greenspan said in 1995. And by the way, from 95 to 2000, although there was a bubble in stocks, there wasn't much inflation. So there was a certain element of truth to what he was talking about. But again, the conditions then were much different. We did not have the same debt to GDP that we have today. We weren't running the enormous deficits that we're running today. I mean,
Yeah.
it's an apple and an orange. I mean, we're in a lot deeper monetary shit right now than we were back then. So I think Warsh's argument that, well, yeah, I can, I'm viewing this the way Greenspan viewed it. Productivity allows us to drop rates. Okay, fine, but you don't have the same circumstances that Greenspan had. So, it's going to turn into a disaster, and in my opinion, and it's going to turn into really high inflation. That's just the nature of the way these things work in terms of, you push this button or you pull this lever and this is what happens, right? If they take rates down a lot, we're going to start another credit growth cycle. And if we start another credit growth cycle, M2 is going to grow substantially. The thing we haven't talked about much here, Joe, and that's interesting, the kind of the big unknown and what part of what will drive how big the big print is and when it occurs is the bond market, right? Let's talk about, the US 10-year, the Japanese 10-year, the UK 10, I mean, all the bonds throughout the world. And again, in my quarterly coming up, there's a great chart. It was actually by Luke Groman who did it, that just shows the trend in all these bond yields, over the past year and a half. And they're all just marching up relentlessly, especially Japan. And, what that tells you is that investors are very much, and gold is marching up relentlessly. And what those two facts tell you is that investors have really come to understand that monetary debasement is a very serious issue. And at the margin, and the thing that's interesting to me is that particularly with gold, a lot of people think, okay, fine, yeah, we get it, but there's a lot of reversion of the mean thinking. Okay, gold's run really hard, therefore it's overbought, therefore I don't want to buy it because I wish I'd bought it earlier. It's too late to buy it now. And my view is no. This is the tide has turned, and it's going to go out a lot further than you ever thought. And so yes, you wish you'd bought gold at 2,000 and not at 4,800, but how are you going to feel when it's at 8,000 or 10,000 or 12,000? Because that's where we're going, right? So because the tide is running in that direction. I mean, the monetary debasement. I mean, until we see monetary debasement start to change. I mean, I'm often asked, people look at my fund, they say, what could go wrong here, Larry? How are you wrong? How do I lose money in this thing? And what could go wrong is if the government gets responsible. And of course, they laugh and I laugh and we all laugh, right? Because that's not a high probability event, but it's not impossible. I mean, you could trim Social Security, you cut defense expense, but if you actually look at, read the news and look at what's going on, we're kind of going in the other direction. I mean, one reason my trade wasn't working that well about a year, at the early part of the last year was that Doge was going to cut, a trillion, 2 trillion, then 1 trillion, then 500 billion. And at the end of the day, Doge probably saved 100, billion or something. I mean, the government just can't seem to stop spending. And here we've got Trump just called for defense expenditures of 1.5 trillion. I guess they were running about 850, 900. So he wants to take us to 1.5. So there's another 600. I mean, there's again a chart in my quarterly that shows if we go in that direction. I mean, the deficit right now, the CBO, and I think they're being conservative. They have it at 1.9 this year, 1.9 trillion, up from 1.8 last year. It's headed to somewhere between 2 and 3 this full year, calendar September of 2026. So, for the first half, we were at 1.6. Although that's not that good an indicator because it's lumpy. Somebody pointed out to me that in 2025, first half was heavy, was big as well. I mean, we'll know a lot more after April because we all just sent our tax money in. So, if there's more tax revenue than we thought, maybe it won't be quite as bad. But the point is that, my view is I don't see anything coming out of government about responsibility on spending, and therefore I'm still comfortable in this trade.
Excellent. So as far as like the trigger for the next big print, obviously the war is making bond yields spike globally. The 10-year right now, November, looking at a chart now, we were at 395. Now we're at 430. We were pushing 4.5% when the war actually just 2 weeks ago. How high do you think the 10-year needs to go before we see something like yield curve control and the true move from what we're at now, which is like 40 billion a month, very modest, to something bigger?
Back in 2023, when it got over 5, they really got aggressive about jawboning it lower, talking about monetary accommodation, etc. They've got the jawbone effect that can sometimes bring it down. It's like saying boo to the bond investors who will short the bonds. But I think 4.5 or 5 are kind of the two. 4.5 is the early warning, and 5.0 is a big problem. And my suspicion is that and it's not just those levels; it's the velocity of the move. I mean, it's something like maybe a failed bond auction, and James Lavish is better at this than I am because he was in that world. But it's the tail on the bond auction and how much demand there is, et cetera. I mean, if it gets to the point where we have a very hard time selling our bonds, they're going to have to do a big print. I mean, by the way, one of the things we haven't talked about, the Fed, is buying 40 billion a month, to keep things going. The Treasury is doing a ton of shit too, and we haven't talked about that. So Besant, over there is really in his own way doing his form of quantitative easing. It's kind of different. It's more like Bernanke's twist. And so what he's doing is he's saying, okay, look, we can't have the 10-year blowout because that means inflation expectations are becoming unhinged and we've got a problem. So here's what we're going to do. We're going to sell short-term bonds, Treasury notes, and bills, and we're going to use the proceeds of those sales. We're going to keep it's going to be, TGA maybe and balance sheet neutral, although he started running down the TGA too, but that's a different story. And we're going to use those to buy back longer-term bonds and keep those yields under control. In fact, in March, they did the largest buyback that they've done in that program. They bought 15 billion of bonds on one day. So you got 40 billion of new money coming in from the Fed, and you got the Treasury spending 15 billion, to buy the longer bonds, keep rates under control. And I suspect they'll continue to do that and maybe increase.
The largest buyback in history.
Yeah, it was the largest buyback in history.
Crazy.
Look, this whole thing is creaking. I mean, it's not, the average person doesn't see it. They don't talk about it. They want everybody to think it's, happy, and S&P is hitting record highs. But the fact is that, the bond market is on the edge of having a real catastrophe. And, today, Hank Paulson, former Treasury Secretary, even suggested as much, which to me is a clue that, I'm sure, I mean, this is, so where does it go and when does that big print occur and what does it look like? I don't know. But I read about this in the quarter. We wrote about it in the quarterly, my partner, David Foley, and I. We have the belief that they've got that in their back pocket. So basically Warsh is going to come in and it's going to start off with some kind of speech about how the inflation numbers are not as bad as they look and they'll be coming down over time because the war is going to get settled, blah, blah, blah. And then he'll say something along the lines of, and this productivity from AI is really going to be a big thing and it gives us a lot of space to cut rates and we're going to have to cut these rates. And so he's going to propose a meaningful rate cut, and that'll happen. Then we'll see what happens in the bond market. The bond market, throws up on that and goes, the 10-year goes to 5.0, foreigners start to sell. Well, that's a clue. If it doesn't, which I'd be surprised, then, maybe they can keep doing what they're doing, just doing the twist and the reserve management. But if the bond market throws up, then I think they've got in their back pocket plan B, which is, and I don't know what they're going to call it. I don't know how they're going to do it. They're so sneaky and they're so creative about this shit. I mean, look at what they did when Silicon Valley Bank, failed. They created, I don't know, BTFP, was it buy the fucking paper? I can't remember what it stood for. But I mean, they'll create some new acronym. They'll create some new program and it will be money printing, but they will say it's not money printing. And, maybe they'll have a special purpose vehicle. Maybe it'll end up on the Fed balance sheet. One thing that you can do is they can go to all the banks and they can, change all their supplementary reserve requirements and say, look, you can buy as many treasuries as you want. Maybe they'll incentivize them to buy treasuries. Maybe they'll say, hey, we'll give you low cost money, special purpose vehicle off the Fed balance sheet, but the condition is you got to buy these treasuries and hold them for a long period of time. I just don't know. And that'll be a subsidy of the banks because whatever the money they give to them will be cheaper than, the bonds that they're buying in terms of yield. By the way, this is not new, right? Go back to the Fed was formed in 1913. This is how they financed World War I. They went out and they sold Liberty bonds at 3.5%, and they went to the banks and said, we don't have enough buyers of these things. You got to buy them. And the bank said, yeah, okay, with what? And they said, well, we'll give you money at 3%. And so they let the banks, and they grew their balance sheet. They let the banks buy the bonds at 3%. The bonds yielded 3.5%. The banks got the 50 basis points. So it was basically a subsidy to the banks for the banks to finance the war. And, isn't that convenient? And of course, this was all against the Fed charter. They had the whole Fed charter. The Fed was created, of course, as we all know, to, make everything more stable, which is just total horseshit because it's made everything less stable. First of all, the war created 100% inflation, from, 1913 to 1920. And then right after that, we had the biggest bubble in history, which led to its bursting in the Great Depression. So good job, Fed. We really are glad we put you in place. But my point is that, they are going to figure out some way to do this print by hook or by crook. But I also think they're going to do it's going to be sneaky and it's going to be masked and they'll have some new program. I don't know what it is, but I feel confident they're going to do it, Joe, because of the math. I guess that's the biggest reason that I'm thinking it's going to happen.
So one of the other things you've been outspoken about, Lawrence, is World Liberty Financial. Particularly it's one of the most, I'd say, flagrant forms of grifting that we've seen recently.
Yeah.
You've been outspoken about it. Speak to that a little bit. And then, what is World Liberty doing, and I guess crypto more broadly, to damage Bitcoin by sort of lumping it in with this speculative casino, if you will?
This is such a tough subject. Those of us who are Bitcoin maxis and understand the promise and the upside of Bitcoin, are so disgusted by the crypto world. And yet, we're kind of semi in bed with the crypto world in the political sense that crypto people have donated a lot of money to certain politicians. And, we have quote unquote a crypto czar. And, we had, Trump and others, speaking at the conference and supporting our stuff in the sense that they supported Bitcoin. Frankly, that was a lot better than Elizabeth Warren's view of the world, right? And so, we kind of held our nose and said, all right, anybody who's in favor of, supporting Bitcoin.
The enemy of my enemy is my friend.
Right, exactly. But we were never, I don't think most of us hardcore maximalists were ever very comfortable with the crypto world because we know that it's mostly a bunch of grifters and scam artists and bullshit. And so, and of course, you get in bed with a dog and you're going to get fleas, right? And so, here we are. So Trump comes along and he's pro Bitcoin, which is good. And, he doesn't want to do the stuff Warren does, and that's good. And so in general, of those two choices, we support, red versus blue. And then the first thing he does, even before he takes office, is he launches Trump coin, which is a shit coin, down 95%. He launches Melania coin, which is another shit coin, down 98%. Tries to sell those to all his gullible, followers. And then, he and his sons and the Witkoffs create this World Liberty Financial and get some of the biggest people in crypto to put their money into it. The names are escaping me now. You might remember them, but they they bought huge pieces of it and put up a lot of money for the tokens. And then, very interestingly, they also ended up getting pardons on some, legal issues that they had, right? And one could question whether A is connected to B, and it seems rather logical that it is. But probably more importantly, they, World Liberty Financial floated all these tokens, and then the tokens really don't have a use case. They don't have any underlying intrinsic value. And the people who bought them are, have lost a significant amount of money. I think they're down 60% from the high. And throughout this whole process on both the Trump coin, Melania coin, the tokens, etc., the Trump family has, extracted, rent, and has sold coins and taken cash out of these things. And as we all know, it's difficult to know the exact amounts, but they're not trivial. I mean, and so this is a classic case of, the insiders who set them up are benefiting at the cost of the investors who are the marks, and they lose money. And so, it just makes me ill. So then I see, I think I reacted in a tweet online. I see, Eric Trump is now, going to be a speaker at the Bitcoin conference. And I was like, what the fuck? I mean, this guy is the son of, of a crypto grifter, his dad, and whatever else you want to say about Trump on this particular issue, he's dead ass wrong, shit coins. And, it's just like, why is he a speaker at the conference? Having said that, I did speak to some people in the area who kind of said, well, look at it from, the conference people's point of view. The Trumps know there's a conference going on. They're, into publicity. They can probably call up and demand to be a speaker. And, what's the conference going to say? No, after all these things that, the administration did for crypto and Bitcoin in general, we're going to shut you out. So I don't know. It's a screwed up, uneasy alliance, and, my personal view would be, I hope Eric goes there. I hope he makes a presentation. I hope all the true Bitcoiners boo the shit out of him. I mean, seriously, because, it's just disgusting what they've done. And it really hurts, the underlying sound money premise of Bitcoin. And so, we just don't need grifters like that in the space. But, here we are, right? And it's the mixture of politics and money. And, there are a lot of people in the crypto world. I mean, XRP is still hanging around. I mean, it's ridiculous, right? These coins, most of them have no use case whatsoever. Most of them are centrally controlled, and they're not Bitcoin. And I spent a lot of time, I try and orange pill a lot of people. That was the whole point of my book, was to try and orange pill the world. It's not working out real well. I mean, we've made progress, but I would have
For now. For now.
Yeah, for now. I would have hoped we made more progress. I mean, sold 50. I'm about 55,000 units sold so far. But I spent a lot of time countering crypto. Because a lot of people know friends who got screwed and scammed and taken advantage of, and they look at Sam Bankman-Fried, and people make decisions quickly, and they tend to generalize, and they use heuristics, and they see that there are fraudsters in an area, and they say, screw that area, I don't want to touch that, I'm not going to go there. And I get it. I mean, they're either lazy, or they're not inquisitive enough to understand that. Yes, there's a ton, and they're right. There is a ton of fraud in crypto. Pretty much almost all of crypto ex-Bitcoin is fraud, but Bitcoin is not. And so it's difficult to kind of get that through, to the uneducated person when they're just kind of initially looking at the space. And it's very disappointing to me. I think it's hurt us a lot. But I think over time, because Bitcoin's not fraud, more and more people come to understand that, and hopefully these other frauds will disappear. I mean, it's still amazing to me. You go to CoinMarketCap and you look at these things, and there's still, Dogecoin. I mean, still coins with just no use case whatsoever that have multi-billion-dollar, valuations. I'm like, what? I just don't get it.
It really is strange. I think Mark Moss at one point said that there were over 100,000 cryptocurrencies, but the stat, Larry, and you and I both know this, is that none of them have ever made a new all-time high against Bitcoin. None of them. All of them trend to zero in Bitcoin terms. And so for me, I think, one of the big things that's really holding Bitcoin back is its relation to crypto.
Right.
You know this, I know this. And, I think one of the other components too is that one of the reasons that Bitcoin is so underestimated is because people are thinking of it as a trade. They're thinking of it as something I'm going to get in and then get out of, and then that's that. rather than thinking of it as a life raft or, this asset that is on a long-term adoption trend. Are there any other things in your mind that are really preventing mass adoption or mass understanding of Bitcoin from really occurring?
No,
Like, what is, yeah.
yeah, I think that's the large. I think we touched on the largest one. I do think the volatility is a little difficult. I mean, I know people who bought at 126 and they look at it at 70 or something, and they're like, what have I done? And that's why, I think it's incumbent upon all Bitcoiners, to when it's not just enough to orange pill people and get them to buy some. It's actually more important than them buying some is them to coming to truly understand what the asset is, and to understand the underlying premise and to understand what it could do. And so I always, when I'm trying to orange pill somebody, I say, look, if you're going to buy this, you need to consider that it could go down 50%. And you need to understand it so fundamentally that if it goes down 50%, you're thinking to yourself, oh, great, it's off, it's half price sale versus I made a mistake and I'm going to sell it.
Mhm.
And that's a really important thing, because it's a very volatile asset. It still is. That'll change over time. It's getting less so, but it's taking time.
Absolutely. Couldn't agree more. I think that in the same way people view like when gasoline prices go down, a lot of folks will go to the station and they'll fill
Yeah.
up extra tanks. I know I did a couple of weeks ago after the Strait of Hormuz. I think if a lot of folks thought about Bitcoin that way, things would change. But as is the case with any investment, that's very hard to do.
It
Like even
is.
myself, when Bitcoin went all the way down to 60,000, I vividly remember I was with my wife out to dinner, or actually out to lunch because it was in the middle of the day, and I immediately opened up River and bought several $1,000s worth of Bitcoin.
Good
And
for
like I had
you.
a pit in my stomach, and I'm like, oh my gosh, is it going lower? And it ended up not doing it, but that was like extremely hard,
Oh
even
yeah.
as somebody who works in the space.
Oh yeah. No, it's look, I mean, humans tend to chase price and they chase momentum, both up and down. And so, the most painful buys are generally, I mean, it turns out that was a pretty good buy for you, and it was very painful. And, like you might feel really good buying it. I mean, I bought some at 100 when it broke through 100. I bought some at 100, 106. It felt great.
Mhm. No, me too.
And,
Yeah.
right. And, oh, it's going to 200. I'm in good shape here. And, I went to 126, whatever. And I'm now underwater on that purchase, but I don't really care. It's just, it's just the nature of psychology. I mean, I think
Mhm.
Buffett had it right. You got to look at this like, it's filet mignon. And, if you know what it is, and filet mignon is good meat and it's worth eating, if the market tells you, hey, guess what? We got too much filet and it's on sale today, you get to buy it for half off. You should back up the truck and buy it. It's a good time to be buying. And I think there's actually a model, I'm sure you're aware of it, I know I am, and that the others should be as well. And is this power law model, which has really kind of come to be, to me, the touchstone of how you can tell when it's cheap and when it's expensive. And I even think Saylor has embraced this. And if you kind of look at his math and his models, it's pretty clear to me he's using it as kind of a baseline case. And it has a 96% R squared correlation looking backwards. So this is not some trivial model. It's actually been proven out over time. And, right now we're at the very low end band of the power law. And, fair value today is like in the 123 or 4 area. We're trading at 70 something, mid 70s. The lower band of the power law is now mid 50s, high 50s, maybe 60-ish. So, and it's interesting we touched that lower band on that spike that you were smart enough to buy on.
Yeah, I'll pull this chart up here. You could see this is the
Right.
power law. I'll zoom in. You can see fair value according to the power law right at bat currently 134.
Yeah,
Um,
right.
yeah.
So you get to buy something that on a fair value median basis is worth 134. You can buy it right now for 75. And by the way, I mean, sometimes it trades well above that fair value, and I think well above that fair value right now would put it into the 200s. So,
Mhm.
and by the way, if you needed cash, or thought you needed cash sometime in the next 5 years, and it went to 200, it probably wouldn't be crazy to trim your position a little bit. Do you know what I mean? But I mean, I don't know if I will or I won't. I'll have to see how I feel when that time comes. I mean, I certainly know if it were go to 300 or 400, I'd probably trim a little bit, thinking that it's gotten ahead of itself. I mean, investment markets always, they exhale, they breathe in, they breathe out, and but right now, I mean, the important point to make is right now we're on the cheap side of the ledger pretty significantly,
Mhm.
and so it's not a bad time to be buying right now. That,
Absolutely.
that could change.
Yeah. And it's always relative too. It's like I always tell people looking out a decade from now when Bitcoin is $1 million plus,
Right.
probabilistically, probably $1 million plus in my mind, will you care all that much if you backed up the truck at 70 versus 50? I mean, yeah, it's quite a substantial difference, but you will still be
That's
very,
exactly
very
right. I
well
mean,
off. It's
I was
marginal.
buying it back at 4,500 in 2019 and 2018, and and I bought some at 9,000, and I bought some at 9,000, and then it went to 4,500. I thought, oh my God, now I really got to buy some, and but prior to that, I bought it at 17,000, and Thanksgiving of 2017 on that first big run. So yeah, it's all over the place, and it argues for dollar cost averaging over time. But the power law does give you a sense of whether you're on the cheap or expensive side of the ledger.
Certainly. Lawrence, you've been very generous with your time. A question here to wrap all of this up, tie it with a bow. Chaos is sort of the word of the day or word of the last several months, I suppose. And it seems like it's going to be the word going forward. In your mind, and this is very difficult to say, do you think that we're heading towards a correlation to one event? If the war doesn't lighten up, if these ceasefire peace talks, it seems like we've had five at this point, continue to totally dematerialize, do you think that asset markets are just going to be in for a rude awakening, bond crash, just exactly like Hank Paulson said, massive print? Do you think that this is
I
the
kind
catalyst
of
we're heading
do,
toward?
to be honest with you. I mean, I think they need a big print. I think they can't do a big print without having justification for it. Do you know what I mean?
Mhm.
And the prior justification, we know COVID was a great justification. The GFC was a justification, and this will be the third one. And so, my sense is, I mean, certainly the way they're behaving with the war and in every other respect would imply to me that, they're going to drive this thing into the ditch, and we're going to get, something's going to break. And when it does, then they'll come through with a new regime. However, as I said earlier, it is possible that they've kind of got it, in their back pocket to do some things that aren't as big a print, but more, kind of printing, but at a more moderate rate, kind of the Lynn Alden, a modest print. It's possible that they do that, and that's what works out. I probably put the odds of those two at kind of 50-50. I think it's 50% they print and muddle through, and 50% something really breaks. And by the way, if it really breaks, it's going to take a big print, because when those kinds of things happen, as you recall, Mario Draghi did it when the euro broke, and he kind of said, we're going to do whatever it takes. I mean, Hank Paulson said the same thing in '08, and then what's her name? Our current guy, said it, in 2020. I mean, he came out, I remember it very clearly after, I mean, it was brutal. The markets, every single market was going no bid, including the U.S. Treasury market. And, Powell came out and basically said, we will print, we will do whatever is necessary to stabilize the situation. He just flooded the world with money. And, it was 5.5 trillion when it was all said and done. And I mean, so, yeah, if the markets are fragile, confidence is fragile. If we do get the correlation of one, that Fed balance sheet's not going to be at 6.6 anymore. It's going to 12 or 20. I mean, it's a much bigger number, because the other history we've seen is that each print is progressively bigger. I mean, Bernanke printed 3.5 over 3.5 years, something like that. I mean, Powell
Mhm.
printed 5.5 over 18 months. So, so this one, I mean, okay, let's, if this thing really
Yeah.
breaks and all hell breaks loose, what are we going to get, 9 or 10 trillion over, 2 months? I don't know. I mean, I just don't know. I think I rate that as about a 50% odds. I rate the muddle through, serious printing, but kind of muddled through printing is kind of a 50% odds as well. So, and
Yeah,
what,
this is what you're referencing here. This is the
yeah.
Fed's
Oh, yeah.
balance
Thank you for
sheet
bringing that
on
up.
the
That's a great
exponential curve.
chart. See, to
Yeah.
me, this isn't an emotional thing. It's actually mathematical.
Mhm.
And I'll explain to people what this really is. So the curve, the exponential growth curve, is the growth of debt. It's about 7% a year. And so you can see, and the black line, the darker line, is the Fed balance sheet, which is actually a proxy for the money supply. Now, Fed doesn't print money. The Fed prints reserves, and it gives it to the banks. The banks multiply it, and they print money. But it's a good proxy. And so what you can see is when the money in the bank money in the system, the black line, falls below the growth of the debt, the underlying compounding growth of the debt, boom, something breaks, and they have to print. And so in 2008, the black line flew, got below the parabolic line. Bang, he printed. See, you can see how he did it in a couple stages: QE1, QE2, QE unlimited. Well, problem is that created a lot of problems, and they hit the top, and then, all right, Yellen comes in, she starts taking rates back up a little bit, and then Powell even decides, well, we're going to taper it a little bit, and then, oops, nope, taper tantrum, repo blowout in fourth quarter of 2019, and then COVID in January of 2020, and bang, we're going to print more. Nope. Oh, the problem with that is we got inflation. Oh, by the way, there won't be inflation; it'll be transitory, which is a lie. But we got 9% inflation. Oops, kind of blew that one. Okay, well, we're going to tighten. We're going to make M2 go down. We're going to push rates up very rapidly, and he did all of that. And so, Fed balance sheet goes from 9 trillion back down to 6. But look at where the lines are. We're right at that point at which there's not enough money in the system to support the debt, and so that informs me that it's just a matter of time before we have to do it again.
Absolutely. All roads lead to the big print. It's just math. The only way out is austerity, but we've chosen time and again.
Well, that's right. I mean, that's right. That would be a way out. I mean, if you want to do the 1929 thing, we could do that, but the world's going to be bankrupt. And, I think politicians will always do the thing that's most likely to keep them alive and in office. And I think a total economic collapse is much worse for them than something. And when they do this print, by the way, the other thing, they'll do it, and there'll be a little bit of a lag between the print and the inflation. I mean, if everything really breaks, the economy might break, and they might be able to get away with the print and not instantly have high inflation if the economy is broken too. I mean, inflation is driven by a couple things. It's driven by demand in the economy and activity. It's also driven by the money in the system. And as you recall, when Bernanke printed, because they froze the excess reserves and started paying, they changed the law so that they could pay interest on them. So that big print wasn't actually consumer inflationary in the way that the next one was, because they issued stimmy checks and the money got into the system much quicker. It was asset inflationary, but not consumer inflationary. So, and my sense is that the Warsh will try to argue that this is not going to be inflationary, even if they do print. Which, in the short term, he could be right. But in the long term, if the money's in the system, once the system starts running again, he's going to be terribly wrong, and we're going to have a lot of inflation.
Chaos.
Chaos. Yeah, I mean, sadly. And look, I mean, we just work here, right? You're not the Federal Reserve Chair, neither am I. We're not the president. We didn't start the war. We're just, citizens trying to live normal lives. We happen to be very tuned into the monetary picture. The monetary picture, in my opinion, is the most interesting story in the world right now. It's the cause and the issue surrounding this fourth turning, and it will have to be addressed if we want the world to go back to being a more normal place the way it was when I was growing up. And I think it will be addressed, but sadly, it probably is going to take a few more crises before everyone realizes this is the core of the problem and says we've got to return to sound money. I think that's coming. I mean, the bright side of it all is I do think that's coming. I do think this whole thing will be wrapped up by kind of the early 2030s. At least I hope so, because I want my kids to live in a better world. So,
amen. Me as well. Well, here's hoping. Lawrence, thank you so much for coming on again.
I always really enjoy our conversation. So thanks for having me on.
Of course, absolutely. And for people who want to check out that quarterly report that you mentioned throughout the show, where can they go?
EMA2, so edwardmarkalpha2.com. Maybe you can put it in the show notes. It's Equity Management Associates, a firm that David Foley and I run. We write quarterly reports. They're free. You can sign up and get on our newsletter, and we'll send them to you. We'll never spam you. And they're kind of a lengthy. Every quarter we sit down and write, here's what we think's going on in the monetary world, and here's how we positioned our portfolio. And so we're talking really about gold, silver mining stocks, Bitcoin, and then the macro that drives all these things, and the politics too that drive all these things. So it's kind of a running commentary of what I've been talking about here. And the thing probably that's most interesting or most helpful to people is I've been talking about a lot of stuff. We use a lot of charts. So there's a lot of, you can visually kind of see what's going on, and it tells you, I think it helps tell the picture, tell the story. The pictures do a good job of telling the story.
Phenomenal. We'll leave that in the description. There'll also be a link to buy Lawrence's book, The Big Print, in case you don't have it already.
Thank you so much. Yeah.
Absolutely. And Lawrence, thank you so much for coming on the show.
Thanks, Joe. Super fun. Enjoyed it.
And then there's one which does nothing, Bitcoin or something like that.
Bitcoin 17.
I could care less what Bitcoin trades for.
It's just a matter